Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today in our call, we have Brian McKinney, the CEO of ICEsoft. ICEsoft trades on the Canadian Securities Exchange under the symbol ISFT. The company is trading at 6.5 cents with roughly 80 million shares outstanding, or about a $5 million market cap. I'd now like to hand it over to Paul Andriola.
Thank you, Trevor. Brian, thank you for joining us today. We last saw each other actually in person well before COVID, so it's it's good to see you again, if virtually, if only. But thank you for joining us today, and we're looking forward to your presentation. I'm going to turn it over to you and let you start.
Cool. Well, thank you very much for having me. Let me try and share this screen here. And let me make that a little bit bigger for everybody. See if that works. Is that any better? That good?
Perfect. Thank you.
Perfect. Well, yeah, thank you both for having me. I'm certainly happy to be here, and you know, living in the land of COVID, it's always a challenge. But there's nothing like selling emergency notification systems during a pandemic. So hopefully we get to introduce people to it. For everybody else, my name is Brian McKinney. I'm President and CEO of ICEsoft Technologies. I've been kicking around the tech industries for a number of years, and have been running ICEsoft for the last several years. So why don't we just get going? As Trevor pointed out, we are publicly trading on the CSE, our traditional forward-looking statement that we've got here, and give everybody a chance to read that. All right. So by way of introduction, ICEsoft, we're a software as a service company based out of Calgary. We have offices in Victoria and Montreal. We are trading on the CSE. We did a direct to list, so no IPO. You know, we have a number of shares outstanding, as you can see here on the table. I hold about 14% of the company. This is all purchased in open market. That is no founder shares in there. And one of the things you'll also notice is that there's a fairly healthy amount of insider ownership, and in terms of where that is. We did a round of financing last March for a price of about 8 cents a share and a post-market valuation of kind of in the area of 6.4 million. The product, so we have two products. We have a legacy product that's quite profitable, but it's in a maturing market, not expected to really grow. We actually have been seeing it in a slow decline for a bit. And we use the cash flow from that, which can be meaningful, to help finance some of our other product development that we have going. And our flagship product right now is a product called Voyant Alert. And it kind of stemmed out of some of our legacy technologies in the mobile space that we had developed for enterprise. And we came to apply it to the community engagement, community alerting enterprise space. So let's just kind of click through and move on. So a little bit about Voyant Alert. Its position is a multi-purpose notification service, community engagement, that sort of thing. It's used both for emergency as well as day-to-day communications within a community. As you'll see as we go through the presentation, one of the things that we wanted to focus on and differentiate with is delivering a different kind of communication package to the end user. So much more enriched in nature. You're going to see lots of imagery. You're going to see lots of maps, that sort of stuff. Our belief was that if we could personalize this imagery and the information that was being presented and do it in a way that it was more relevant to the end consumer, then they would get more value out of it and be in the position to make more informed, better informed decisions during a critical incident. And as a consequence, that tends to drive a higher level of engagement and a higher level of follow through in terms of the calls to action. When we developed the service, it was much more for with a mindset that rather than go after the large cities, the large urban deployments, we kind of recognize that that's where most of the players in the industry we're targeting right now. 50–60% of North Americans live in communities that are 200,000 or less in size. And we decided to go after that market. And we kind of built the product around optimizing it for small to medium-sized communities, kind of regional governments, rural deployments, and enterprise. Kind of our go-to chart. So if you happen to live in an area that's serviced by Voyant Alert, you may have seen or received some of our alerts here in the past. We certainly have a fairly significant footprint across Canada, as you'll see. Some of you may have gotten yesterday, depending on where you lived, one of the Alert Ready alerts from the federal government. Probably resonates with you. I know BC got it, and certainly some of the Maritime and Prairie provinces did. They do a great job of getting communications out. They tend to all be text oriented. Most of the alerting systems seem to be that way. And as a result, the details can kind of get lost in all the words in the text. And so this chart kind of contrasts the two. So, I mean, you can see and hear about, oh, there's a train derailment near range crossing 283. In our case, given access to the right bandwidth, you know, we'll show it basically, here's where you are or a point of interest to you, like your kid's school, relative to where the incident site is. And we can personalize that information and say, hey, your child's school is located 200 meters northwest of the gas leak. This is the evacuation route, and this is the pickup location now established for the school. So it's that kind of additional context that we think really pulls people in and delivers a more value-added service. A little bit by the numbers, we're now serving over about 230 communities across Canada. That's about 1.1, 1.2 million residents. As we see, as we'll go through, we've been doing reasonably well in our competitive bid situations. We've been involved in a number of them in the last 12 months and come away with a number of wins. The thing that we're perhaps most happy with is with those 230 communities, we see a 100% renewal rate. So as a SaaS business and as an investor looking into SaaS businesses, you know, 100% is you know, maybe indicative that we're not charging enough, but we're pretty happy with the fact that we're seeing 100% renewal rate in terms of what we're doing with our subscribers. When we talk about Voyant Alert, we talk about three markets for us that we're going after. And the first one is the Canadian municipal market. As I mentioned, we're trying to target communities that are in the small to medium sized range. So think everything from a village of 500 people to larger communities like 200,000. So, you know, at the top end of our spectrum, we're in regional districts and counties that are getting close to 200,000. We're in places like Guelph and Nanaimo, those kind of you know, medium-sized urban centers. We launched in January into the US with some sales. Obviously a much larger market, required a little bit more marketing boost on our side in terms of what we were developing and some infrastructure costs that we had to make. But it's obviously a much larger market, and we're looking forward to some of our first design wins starting to hit here in the US. The third market sector that we go after that has been really exciting to us and really interesting has been the enterprise sector. And this is targeting those kinds of enterprises and businesses that have to either secure their employees for one reason or another, or who have clients or community obligations in terms of alerting nearby people and facilities. And we'll just touch on that. So on the Canadian market side, you can see here a little bit of a map across Canada, 230 towns and cities under service. We're doubling roughly year over year, which is what you would expect in the early stages of a SaaS business. We bill on a subscription basis and a usage basis. So when we bring in a client, we typically charge them X number of dollars per citizen per year. So a community of say 10,000 people, we would have an upfront subscription fee on average in 2020, it averaged about 30 cents per resident per year. That number, as you'll see later on, is growing, as time goes by. We're expecting to average about 45 cents per year per resident per year at this time. Augmenting that, and something that we don't talk a lot about, are the usage fees. So depending on the nature of the contract that we've engaged in, we also bill that client, 4 cents per text or 2 cents per email, or an app push event type of thing, depending on the nature of the client. We don't tend to put that kind of number into our forecasts or our estimates, simply because it's often hard to predict. So if you think about a summer emergency, a forest fire, what we don't want to do is kind of confuse people with estimates as to what our usage fees might be. And we're totally at the whim, perhaps, of what the weather is like. So a dry, hot summer, we probably make a lot more money than we do like last year, where it was a lot wetter in some cases in terms of what we're seeing. So the numbers that we quote here today are basically upfront contracted license fees when we talk about the ARR here today. We have about a $300,000 per year licensed subscription based, and then over top of that, we overlay some of the usage fees. The other interesting point is that we are seeing about a 66% lead sourcing coming from referrals now. So as we gain a foothold in a part of the country, these small communities talk, and they talk a lot. And so that's really helping. You'll see clusters: Alberta, BC, Saskatchewan, strong footprint there, Niagara Peninsula, and then out in the Maritimes as we've gotten footholds. And we roll these out by offering referral bonuses in some cases initially, and then we kind of pull those back as we establish a presence there to help keep things down. Right now, we're sitting on about 38% of BC in terms of landmass covered. So we're the largest emergency service provider in BC in terms of what we're doing there. US market just starting to roll out. You'll see that we kind of established a Western corridor in terms of what we're initially going to be rolling out to. This kind of geography really mimics a lot of what we're seeing in Western Canada and Ontario. So where natural disasters tend to be a little bit higher. We made a conscious decision to avoid the Gulf Coast states in and around Georgia and Florida. And we wanted to kind of really get our heads wrapped around that a little bit more in terms of how to roll out there more effectively. There's a lot of FEMA coverage there for hurricanes. And some of those places have got a number of different structures and government tiers. So strong believer in walk before you run. And let's find out what really works in some of these US markets first, and then duplicate that and move it along. In terms of expectations, we do expect to see a higher dollar value per resident in the US. Part of that is a currency exchange. Part of that is just, I think they're able to support a higher number there. So why do we like the enterprise market? We like the enterprise market because they make quicker decisions and they pay more money per user, is basically it. We expect that they're probably a little less sticky than the municipal sectors. We've closed 10 of these deals now in the last 6 months in the enterprise area without a lot of push. Kinds of areas that we're looking at is mining, manufacturing. So think about an open pit mine that might have alerting, obligations to neighboring communities. Organizations that might have employees working in remote areas on their own, so that require lone worker management stuff. We can provide some of that oversight and umbrella coverage for them. The other areas where we're seeing a significant uptick are in the areas of utility services, so rural water utilities, gas utilities, and in property management. And so if you kind of extend that into a residential property management kind of a view, a lot of these property managers might have communities where they're managing 20,000 apartments or condos under their control. That's basically a small to medium-sized city right there. In terms of what we can bill out, instead of 30, 40 cents per resident per year, we're able to recover here something on the order of $10 to $12 per employee or per client per year. in terms of what they're communicating to. So think of it as a little more than an order of magnitude more in terms of what our margins are in this sector. So how have we been doing, and what's the impact of COVID? So we've been realizing since we started the company and started rolling out the service here, accelerating community sales. So 2019, we had 81 total communities under service. 2020, that grew by 170%, up to 191. So far this year, we've added another 40 or so on top of that in the first quarter. So that seems to have sustained us through COVID. You know, people are still buying, which was good, and we kind of are forecasting that to continue to grow out through our outer years as we see it moving along. Actually, we're calling it down just slightly on some of that, but we're happy with the onboarding efforts as we move and roll out. And this is Canada only right now. This is the impact of COVID, and it wasn't nice, and it took us a little bit to kind of get our heads wrapped around the whys and the wherefores here. But the other vector that we really monitor hard, the second one, is the average community size. So we onboarded 170 communities last year. That was great. 2018, the communities we onboarded were 5,600 in size. 2019, that grew to about 9,500 in size per community. And that was growing at about 10% quarter over quarter. And so, you know, when we were sitting there in December 2019, putting out our budget for 2020, we were thinking we were going to be kind of north of 10,000 on the average community size. COVID hits, we're still selling deals, but what happened is the average size of the community just fell through the floor. And so it went from 9,000, as you can see, to something just around 3,000. And it took us a couple of months to get our heads wrapped around what was going on here. But what it was that the larger urban centers, their resources, the people that make the key decisions, their town councils, incredibly focused on COVID response, as they should be, you know, in terms of what's going on. But it was the smaller communities, the more rural communities, that were getting assistance from districts or counties or at the provincial level to a greater degree than maybe what the urban centers were. And as a result, they had resources that were freed up to be able to make purchase decisions, to assess the product service, and then to take it on and roll it out all in one fell swoop. And so we saw this big skewing between, you know, our historical numbers and the others. And the million-dollar question here is, when do we start to return back to pre-COVID numbers as part of the growth rate? And you can see all of our budgets and forecasts right now. We thought we'll play it a little bit conservative, and we're basically forecasting it out to 2022 before we actually see a return to pre-COVID density numbers, if that makes sense, in terms of what we're doing. We see that trend already starting Q1 here. We're back up to about 3,600 on an average community size. But, you know, going into 2020, we certainly expected higher sales. And while we got the number of sales we were kind of looking at, the size of those were what was really impacted there. And the third magic number that we look at is the number of dollars we realize per resident. So when we go in and we bill a company or a client, we look at the number of users that are potentially on that system. So residents in a community or employees in an enterprise. And again, this represents the Canadian municipal sector, just to kind of give you a flavor. In 2020, we were selling deals at about 30 cents per resident. Year to date now, we're up to close to 40, and we expect that number to get closer to 50 cents by the end of the year in terms of where it is. Three things are contributing to that growth rate and will continue to drive that growth. One is a general ceiling increase, where we just increase our prices. We're exploring where is that ceiling going to be. And so when we look at the renewal rate, that's the question is, you know, when we start seeing that fall off, we'll know that we're kind of there. The second one is our 2.0 release, which is what's coming out here in another month and a half or so. It allows us to effectively double dip on the users based on the tierage of government that they're in. So think of being able to go in and sell the product to a county for 100,000 users, and then go into that county and sell those same users and access to the different constituent municipalities within that county. And so that doubling down allows us to increase the average over those 20,000 or 100,000 users, because we're basically getting paid for them on multiple occurrences. Now, you don't win 100% of the constituent cities, but you win a higher percentage if the parent government tier is running the service. And the third is an add-on option. Things like lone worker modules that we're adding in, or tourism modules for some of these communities as they look to return back to pre-COVID operations. When you multiply those three vectors together, you kind of get our targets in terms of sales. So for 2021, we're looking at something in the neighborhood of $600,000-700,000 of ARR. So coming up from kind of the three, we should be more than doubling. It puts us at about a $2 million annual recurring revenue rate sometime in mid-2022, and by 2023, we should be in that 5 range, is what our targets are that we're shooting for. We alluded to this earlier. Our sales are really fueled by the customers and the clients. So we're dealing with 100% retention rate, which is great. The other number we're really thrilled about is the fact that we're seeing a 66% of our leads coming in from customer referrals now. And that's just a validation of the stickiness of the business, and then the level of satisfaction that we're seeing at the client end. When we translate that down to client acquisition costs, the referral business certainly is driving down our acquisition costs. Rather than laying off folks and reducing our marketing efforts and stuff like that, we're taking those resources and we're diverting them to new market opportunities. So while Canada is now spitting off, 66% referral rates, we now take that resource that we've freed up and we target them now at enterprise or into the US sectors. The other thing that we're seeing is the lifetime value, and it's increasing as we float the numbers up, but it will also start to increase more significantly as we migrate back to pre-COVID levels in terms of the population densities of these communities that we have. The other thing I'll point out is that when we do our lifetime value calculations, this is based on a 5-year lifetime. It could be much longer than that. It could easily be 6 or 7. That gives us an LTV to CAC ratio floating up somewhere north of 3 here is what we're shooting for in 2021. Preferred solution. I mentioned this at the start of the presentation. We've engaged in 22 competitive bids through 2020. We walked away with wins in 18 of 22, so an 82% win rate, which we're thrilled with. 10 of those engagements had an existing incumbent. So not somebody, it wasn't a new green pasture kind of opportunity. This was somebody that we actually had to overcome the displacement costs in terms of getting the win there. And we won 9 out of 10 of those. In 12 cases, we were up against Everbridge. Everbridge is the market leader in the space, our biggest competitor in North America. They're doing about $200 million a year US in revenues and sales. They're currently trading at 18 times trailing 12-month sales on the US markets. And I'm not here to justify that in any way, shape, or form, but what it points out is that this sector seems to have a higher multiple that it's attracting in some conditions. And we managed to beat them again, 12 out of 12 engagements, which we're very happy with. Of the 4 bids we lost, 1 had an incumbent, 1 opted for a local group, and then we lost 2 others in the fact that they were looking for some particular features that we didn't have yet available. Wrapping things up a little bit here with some objectives and guidance that in terms of where we think we're going. We would like to be at 300 communities under service by the end of 2021. I think that's certainly doable. We'd like to be exceeding that 600 to 700K in ARR. We're currently sitting at 230 and 300. The big wild card, as I mentioned, is how quickly these communities are going to recover coming out of COVID. We tend to think that we're very bullish on the fact. So we think that as people start to re-engage, One of the things that will really be driven home is the need for the services that we provide. Communities saw that big time. So we think, as we pull out, it should be really good. New market introduction, we want to be seeing those sales in the US come in and 2 other vertical markets. We're certainly seeing that in enterprise right now. We've already got those secured and are growing them. Year-end revenue and profitability, looking for about 1.7 million with an adjusted EBITDA loss of something better than 350K on that one. And then with annual recurring revenues, again, we're looking at kind of longer term, 2 million by mid 2022, and hopefully something in the neighborhood of 5 is our objective in 2023. Certainly have more information, happy to jump into it, but why don't I just kind of wrap that up there and hand it over.
Brian, that was great. I love it when you cover a lot of my questions, so it makes my job a lot easier here. Let's talk a bit about the sales process. You're dealing with government organizations for the most part, not counting your enterprise. How hard is it to crack this? And do you sort of knock on the door of City Hall, or are there RFPs that you're typically responding to? Give us a sense of how that works.
We do a little bit of both. One of the things that we find is that the larger the community or the organization, the more inclined they are towards RFPs, simply because the dollar value is higher. The advantage of small to medium-sized communities is you can avoid that RFP process, and the decision-making cycle is quicker. So, a community of 20,000 probably makes a decision in two months, 2.5 months, a couple of visits to town council. If we were looking at a larger community like a Thunder Bay or something like that, we might get involved in an RFP process, and it might end up taking, 4 or 6 months. When we knock on the doors first, it's typically depends on the size of the community, but the smaller communities will be knocking on the fire chief's door, and they're usually the ones running the emergency management programs, or we'll find the emergency management coordinator for that community. As we engage with them, they're introduced to the fact that we can use it as a general community engagement, and they start to pull in director of communications, the utilities staff, that sort of stuff. And you kind of get a collective of supporters for the deal. In Canada, most recently, a lot of this stuff has been abbreviated and shortened with the referral process, and that's really helped us a lot.
And does any of your services, does it usually displace other costs? Like are municipalities able to save money by using your service in any way, or is this a new service that's typically they have to go and find funding for? How does that work?
No, it's usually a cost saving for most of them. If you think about it, a lot of these communities have obligations, say a boil water advisory. So what we're doing is we're saving them going door to door to knock on doors. So we have a receipt capability built into the system, so they can document and have confirmation back that a lot of these people have received it. So that's fewer flyers that they're printing, that's fewer doors that they're spending time knocking on, as an example. In some cases, we're displacing other systems that they've already paid for in terms of doing it. In some cases, it's things as simple as a dispatch service, maybe, that they have that they're engaged with, and they're getting it as a free one. Once we roll out our lone worker monitoring module, a lot of these communities have dedicated a receptionist to contact all of their lone workers on the hour, every hour. That's a half a man day just on the phone contacting the lone workers in some cases. And so when we automate that process for them, that can result in considerable savings.
Perfect. So you did mention, Everbridge is a competitor. I mentioned there's others out there as well. But what makes you better?
A lot of it is so 2 elements. One is the visual nature. So we talk about richer, more contextualized information. So that drives a higher level of engagement for sure in terms of what it is. I mean, that comparison chart that I showed you right at the beginning that we had, this is what makes us better, and it's a question of which would you rather. So in an emergency, which one of those is going to give you more information quicker. And that's a huge deciding factor for us. The other one is our target audience. You know, we can debate whether it was smart or not to go after the small to medium-sized kind of communities, but that's allowing us to differentiate in a really big way between what it is that these folks are getting. You know, it's a different language. A lot of the folks that we deal with are wearing 2 or 3 hats. And so the ease of use of the system is a big factor for them.
And give us a better sense of the sort of the nature of your competitors. Now, Everbridge, I think I saw a note there. It says they do about $200 million a year in revenue. Are they predominantly just doing this? Do they do other stuff? And what's sort of the size or nature of the other competitors you're dealing with? So
there's probably, I don't know, let's call it 6 or 7 that are kind of in that 50 to 200 million a year range that are there. They all tend to go after municipals and or government institutions. So like the US military bases, that sort of thing are very prominent ones. These larger ones, because they're dealing with larger, more urban centers, have a larger palette of back-end integrations that they focus on for dispatch and post-event analysis and stuff like that, ERP system integration, that sort of stuff. And because we're dealing with smaller communities, that's stuff that we can avoid and use it to simplify things. Enterprise is the third leg of the stool that most folks are going after in that sense as well. So, you know, we kind of play in the same thing. We've just scaled our feature palette down a little bit to focus on the smaller organizations.
And do you have grander plans to go after the bigger market sort of bigger customers as well, or is that sort of are you going to stick to your niche, I guess?
I think first of all, we like to listen to our clients and we're letting them kind of steer it the way. We don't run away from the bigger opportunities. We participate in those RFPs and we do reasonably well with them in terms of what we go after. Part of the strategy is one of influence. So if you were to look at some of the communities that we've won, you'll see that there's a surround and attack the middle kind of thing. So a lot of times where we're very successful is we onboard the bedroom communities around the larger, more urban centers. Most of the time, the government officials that work in the large urban centers live in these small communities. They get exposed to the product and the value proposition, and then that gets brought across. So for us, it's a little bit of timing in terms of how we bring it in.
And I imagine there must be some cross communication that these different municipalities have to deal with. Does it ever benefit by, you know, 3 communities that are near each other having the same system, or is that, you know, do all the systems have to speak to all the different systems to begin with?
Yeah, we've actually, when we started it, we envisioned that we were going to have community overlap in neighboring communities. And that's what the 2.0 release is all about, that we have coming up here in 6 weeks, is to facilitate that kind of interaction. Now, it's happening earlier in our life cycle than what we anticipated it to happen. You know, when we started, we kind of figured that it was going to be kind of spread out more homogeneously across the country. And what we realized very quickly was that it was very, you know, grouped together and clustered, and that was driving the benefits of you know, that shared kind of response across the regions.
So it sort of leads me to my next question as far as other new initiatives or technical new initiatives. What's going into 2.0, and what's the roadmap for where you want to improve the product?
Yeah, and so one of the things, I'm not sure if I've got it here, I don't. So with 2.0, what we're doing is we're disassociating the users from the region and the communities. So this gives the users freedom of movement. So you'll be able to log on to the system and drop a pin in Kamloops and say, I want to monitor my mother in St. John's, and kind of identify that as a flag. And so you'll kind of get all of the different information you want from each of the respective alerting centers that are on the system. As you travel, if you were to be using the app and have enabled mobile tracking, as you enter into a new zone, you'll be receiving emergency alerts that pertain to you as you're in that area. So a lot of freedom that way. For the communities, it means that they can better distribute to neighboring communities as required, or overlaying those communities. The other feature that we're doing is we're modifying the system in a manner so that they can more effectively use this for things like economic recovery. One of the big demands that we've seen coming out of COVID here is for things like, how do we use the system to attract and service tourism a little bit more, or promote buy local campaigns a little bit more effectively, and grow that vector.
Well, it sort of leads to my next question is, like, technically, how does a community contact the sort of the receiver? How does this work? If I'm all of a sudden in Tofino and I'm there, I'm not a resident, but how do I, if I do, get contacted by the community?
So what happens is when you go to that community, you can register, and a lot of times it'll be in your hotel or whatnot, the instructions on how to do it. And it's as simple as downloading the Voyant Alert app and just advising where you want to be monitored for. You can put different static locations across the country, and we'll let you know about actions that are going on there. Or alternatively, we monitor your phone's location as you're going through, if that's something that you wanted to have enabled. And a little bit of a misnomer on the privacy side, we don't actually monitor your phone. What we do is we send you the alert geometries to your phone, and your phone decides whether it's appropriate to receive that alert or not. In that sense. So we're very conscious on the privacy side about staying away, but the app is free to use. And, as a consumer, all you need to do is download it. Likewise, you can do the same thing and register to receive text messages or voice calls.
So it requires people in the community to download an app?
Download an app or go online and register.
Okay.
In some cases, communities already have a data roster, and they ask us to import it, in which case we do so in a manner that's compliant with the privacy policies and legislation of the provinces.
Gotcha. Okay, so in the event that I were to, again, travel to Tofino and there's a tsunami alert, if I don't have the app, I'm not getting the alert, or how does something like that work?
So what would happen is, if you haven't registered to receive alerts in that area, or you don't have the app and we're not tracking your location, you would not receive the alert. So this is a little different from Alert Ready, which kind of has it's the federal government activating their control over the CRTC and then forcing their way onto the telcos and talking to every cell phone. So in this case, this is the local municipalities sending out the alerts for themselves and saying, hey, we have a tsunami coming in. And virtually all the time, we're faster in terms of getting that alert out to people, and in terms of what we're doing and doing it. We also reach now to the landline phones that others typically don't, in terms of what they're trying to do.
Gotcha. Okay, better understanding now. Okay, COVID, you mentioned COVID a number of times. Do you, first off, operationally, you guys, I mentioned you're a software company, so you're sort of working remotely for the most part anyway. Is that the case?
Absolutely, yeah. Everybody's working from home right now. We took advantage of COVID. We had a lease renewal that came up last year in the middle of COVID, and we responded accordingly. We were very effective at working remotely, so we just downsized that office right down to a single couple desks.
And going forward, what has COVID done? Is it brought on more challenges, or do you actually see more opportunities for your sort of your business and in the sector due to what's happened to COVID?
So, we kind of talked through the financial challenges in terms of the average deal sizes that COVID impacted us with. Long term, we see this as a big push. It really underscored the need to communicate with your community members and your residents as you go forward. So we believe that will fuel a huge demand coming out of it. The other pieces were vectors that we weren't expecting, which were things like local economies. How do we do the buy local? How do we support our community to come back onto its economic feet, drive tourism? And what we're seeing happening is those clients that were with us through COVID and have been using religiously the service, they're coming back to us now looking for feature enhancements and expansions to grow the service itself fairly organically. The communities that we worked with have been incredibly creative during COVID in terms of how to spontaneously drive it. Some of the ones that we were amazed at, communities in Newfoundland that are renting out the local drive-in theaters for every Friday night to have a mass drive-in event for their communities, right? Everybody's staying in the cars, everybody's staying distant and healthy, but it's bringing back that social fabric that people were missing. And they're using Voyant Alert to communicate this every Thursday night, the announcements going out of what the Friday movies are. They're using all of our rich media content to put the billboard up and the video clips and the screen captures of, Raiders of the Lost Ark is showing tomorrow night, you're free to attend kind of thing. Great stuff going on all around Canada.
That's great. That's awesome. Okay, so I mean, you're still a small company. You're a SaaS business that requires, you're sort of building for long-term revenue. Do you have a balance sheet right now that sort of gets you to where you need to cash flow wise, or do you anticipate having to raise more money at some point?
We're having that discussion right now at the board level. We're not cash flow positive. Q1 was really close, but the decision in front of us is, do we want to pull back a little bit on our sales and marketing? Because obviously the last round didn't get us as far as what we were expecting it to get because of the impact of COVID. And so we're having that dialogue right now, which is, are our shareholder interests going to be better served if we do another round of financing, keep our foot on the accelerator from a sales and marketing point of view, and kind of drive and fuel that investment as we pull out of COVID? Or are they going to be better served if we kind of pull back a little bit and just grow a little bit more organically? And, we don't have the answer for that right now. I think there's some elements that it'll depend on. I'm not quite sure what the appetite is out there yet, or what the valuation might be drawing. And I think those two things have influence on the direction that we'll take.
Mm-hmm. I think I saw somewhere your last financing was done at 8 cents back roughly just over a year ago in March, I think. Yeah,
it was back March, April kind of thing. We did an 8-cent round for about 1.2 million.
1.2 million. Okay, fantastic. Okay, and you mentioned that insiders own roughly 55% of the company. That's correct, right?
Yeah.
Okay, good. I've got my notes right. Well, listen. Why don't we open it up to a couple of the questions I've got here from some of the listeners. We'll go through those, and with the last couple questions I have. Okay, here's one. How can you afford to get paid such a low salary?
Yeah, it's a question I get asked by my family all the time. Somebody's obviously been reading the MD&A, which is great.
Yeah.
We certainly approve that. When you're growing a company, sometimes there's periods of austerity, and I think you need to lead by example, both to your shareholders and to your employees on that element. We're fortunate; our needs aren't really high in terms of where it is. And we did really well with my prior company in terms of, this ICEsoft is not my first company. I started my career at Nortel, did another company called Odyssey Technologies, had a great exit, then cap based. And we're fortunate that we're in a position that it's like that. And I think, as you go through the life cycle of a company, when you hit those periods of austerity, it's incumbent, if I'm seeing others making sacrifices, other insiders stepping up and writing checks, I just don't see any other way. I think you got to do it this way.
It's good. It's good you brought that up. This is not your first rodeo. You've sort of done this before, and you know what it takes to successfully run, build, and eventually sell a business.
Yeah, that's for sure. I mean, I look at the first one that we did and we had a lot of success with, and there were frothy days in and around it. And a lot of times it just takes a lot of luck and being in the right place at the right time. This one really feels like we're making a difference to people's lives. I couldn't say that necessarily about the first one, but this one, is making a social impact to a lot of people and a lot of communities and doing good. So, it's a different kind of a reward. And hopefully the fiscal stuff will follow. I'm a big believer in the consequences of a SaaS business in terms of a return and what we're building here. It just takes a little bit longer. And sometimes you just need to be a little bit more persistent in how you address it.
Now, earlier you mentioned sort of some of the size of the addressable market, but can you give us a sense of how much you think, anecdotally, it's probably a hard number to substantiate, but anecdotally, how much of the market's been penetrated so far?
Different in Canada and the US. So in Canada, I would say roughly, probably 50% has been penetrated in terms of where it is. And we're not afraid of displacement. I mean, displacement takes a little bit longer for us, but we've proven that we're very successful in displacing people. In the US, I think it's probably more like 75-25 with the 75 penetration and a smaller footprint there in the US. And again, we're not afraid of the displacement. Contracts in the US seem to run a little bit longer than what they do in Canada. So the cycle time and the opportunity to displace may be a little less frequent, which I think is relevant. And I think in the enterprise space, I think that's just getting started.
Okay, interesting. Lots to work on there. Okay, another question we've got here is just wondering about the technology. During yesterday's emergency alert test run, I received a text but no audible signal on my iPhone. My son's Android phone got a text and a loud alert noise. So basically, is your technology at the mercy of how every single user has their phone configured?
Yes and no on that one. We do whatever we can in terms of doing it. So out of the box, generally speaking, you have settings that we control and we override, and you'll get the loud klaxon sound. And I can tell you that 95-98% of the people that download the app, for example, are going to get that sound out of the box. Do not disturb is a local privacy feature that we have no alternative but to honor, and we're inclined to honor that anyway. But what we do is when you start up and you download that app, we do provide you with the links on, these are the 4 buttons you have to push to override your DND and let void alert wake you up. We also have other features that we build in so that in places like Tofino that you mentioned, people were worried that, hey, I want a text message in the day, but I'm worried that I'm going to sleep through a tsunami alert text message when it's 2 in the morning. And we give those kinds of features an ability for them to ask for a phone call override in the event of an emergency between these hours type of thing. So, we built in as much as we can in the system to allow you to configure it if that's what you want to do. Default, we've got the majority covered, but we also have to play by the rules that Android and Apple set out on their different operating systems.
Right, gotcha. Okay, so the next question has to do with M&A. Any plans for M&A?
We look at that. It's kind of tough when we're as small as we are. So in those cases, we look at a merger as a growth vehicle. And we're constantly looking and assessing. We think that there's some interesting opportunities out there, either in the GovTech issue area or in the dispatch area. There's certainly some. As we look at some of the economic benefits, the buy local campaigns that we're getting pulled into, some of the tourism stuff, we're thinking that there's elements of couponing that might play where we can do that. That's probably more of a BD effort and a partnership effort than an M&A. But we're always thinking and looking over those. From an exit point of view, I think M&A is a likely event. At some point, we're going to get big enough. And as you point out, it's not my first rodeo. I know the numbers. either we're going to crash and burn, or the odds say that 80% of the time, if we're successful, we're going to get taken out somewhere. So, you know, we kind of keep that in the back of our mind. Mm-hmm. But I think what we really want to do is keep our heads down and get that ARR number up. Mm-hmm. You know, good things will happen once we're throwing off cash and that ARR number starts creeping north of 5 and then up to 10.
Mm-hmm. Mm-hmm. Gotcha. Okay, another question here. Also, I guess each municipality or company needs to provide you with all the phone numbers for their communities. Just curious how this works, since cell phones are very portable and move between areas. How's the master list obtained?
So 2 ways that we enroll. One is an organic one, and about 70% of our communities opt for organic growth. So they voluntarily register. We help them with the marketing campaign and getting the word out and the launch process. It's everything from printing off little business cards and giving them out to the grocery stores, and they go into people's bags at checkout, kind of thing, to getting the word out. A lot of social media pushes. We see about a 15 to 20% registration rate when it's organic like that. And that's not year 1, that's kind of by year 3, you're kind of growing into that rate. For the other models, they have a list that they've obtained somewhere. Sometimes it's a white pages list or something else. And then they ask us, can we do the import? And we go ahead and we do that, again, in concurrence with the privacy legislation. When people move, we can detect whether or not they've dropped their phone number, in which case we do auto clean kind of routines. With the 2.0 release that we talked about, when they move, the app will move with them. And all they do is they identify their new home location, and it's as seamless as that. And then the accounts will move from, you know, their one community over to the other community as they've relocated automatically. Mm-hmm. So that's one of the advantages of that transient nature that we're trying to support.
Mm-hmm. And do you ever is there any sort of incentive delivered to residents to download a free coupon to, you know, drive-in movie or something like that? Any opportunity for that sort of thing?
Not from us. We've had clients kind of take that approach. Mm-hmm. And again, I wouldn't say that's a prevalent approach, but mm-hmm. some of them have certainly been thinking out of the box to kind of stimulate that. A lot of times at the municipal level, they're very, very conscious of the privacy legislation obligations. And so they're very, very careful about how they incentivize things and what they're doing. But yeah, we've seen the kind of thing that you've suggested there being employed.
And then last question from the audience here, how difficult would it be to duplicate your technology?
You know, it would take a couple of years. You know, in terms of where it is. I think this is going to sound a little weird, but for the larger companies, I think the challenge is almost more cultural than it is technical. You know what we've done, people can do. We have some protected technology that we've employed, but you know, people can always find a way around that and come up with their own story. Culturally, I think it's different. I think it's a lot harder to take a company that's used to selling to large urban centers and tell that sales guy that now you got to go out and you got to knock down 20 smaller deals instead of this one deal that takes you 9 months to get. You got to do 20 deals and you got to do them in 4 months. You know, the whole commission plan, everything else, it's a big cultural shift for people to make that. It's a lot easier for a small company like us to move up the food chain than it is for them to move to a more rural kind of a client base. I actually think that's the bigger, more formidable defense wall that we have, rather than necessarily the technology.
Yeah, fair enough. So listen, as investors, what metrics should we be watching closely to determine whether you're executing your business or not?
It's going to come down to these 3 right at the beginning, and I'll just go back to them. You know, are we nailing our community sales? Are those metrics still doubling year over year in terms of the size of the communities? The dollars that we're getting per resident or per employee, and we report on all of these in all of our MD&As. right? And because these are the measures we want you to monitor and track and hold our feet to the fire for. Is that trending in the right direction? And that's going to pick up things like our 2.0 rollout. Was it successful? If it was successful, then within 4 or 5 months, we should be seeing an uplift in this number here. And then the third vector is what is this average size of community doing? And this is the one that's a little bit more of a roll of the dice. Mm-hmm. You know, are we going after those bigger ones? Do we want to see that recovery? Absolutely. But, you know, you have to have an audience that's available to listen to you in some cases. And what this has said was that through most of 2020, that audience was busy focusing on something else. Mm-hmm. And so this is the one that's to a lesser degree out of our control, or to a greater degree out of our control rather. But those are the three numbers: the number of communities that we're selling to and we're onboarding, the average size, and the dollars per resident that we're getting.
Fair enough. Perfect. We've come to the end here. What we always like to do with our presenters is give you an opportunity just to sort of leave everyone with a parting message or a key takeaway. So Brian, is there anything we missed or anything you want to make sure that everybody walks away with today?
You know, from an investment point of view, I think we're a very promising investment. It's certainly going to be a longer term, like any SaaS company as you build it. But ultimately, if we stick with it, we're going to get those larger returns. The fact that we're sitting with an 82% win rate on competitive bid situations, 100% renewal rates, the fact that we're displacing the market leader on a regular basis, those are all positive signs and positive indicators that we want people to track and, you know, buy up a couple of shares, kind of go for a ride, see how it goes. Pay attention to our news releases. If we do have a raise coming up, then we'll certainly be making it known publicly and giving folks an opportunity to kind of come along with that as well.
Fantastic. Brian, listen, if anybody wants more information about ICEsoft, what's your website address? How do they get more info?
So they can go to ICEsoft.com or they can go to voyant-alert.com. Either of those will get you there. And just put this up here at the back end of the screen. You know, or brian.mckinney@icesoft.com will get me as well in terms of where it is. And I do answer the phone. So there you go.
The beauty of microcap companies, you can talk to the CEO, so that's great.
That's right.
Yeah, listen, we've been speaking to Brian McKinney, CEO of ICEsoft Technologies. Brian, it's been a long time since we spoke last. We certainly will be following closely and looking forward to an update in the near future.
Paul, thank you very much for having us. We certainly appreciate the opportunity, and hopefully it won't be so long until we speak again. And I'd like to thank Trevor for setting it up as well.
Awesome. Thank you, Trevor.